Hello everyone and welcome to IBA's Engine Market Update. My name is Melissa Wybrow, Marketing Manager. Thank you for taking the time to join us today. We have a very comprehensive update planned for you. As you can see from the slide, we will be touching on order activity, market performance for both narrow-body and wide-body engines, a look at the pros and cons of OEM control, and what's in store for the A380 engine market. And then we'll finish off on a lighter note, looking back at the performance of the Epic 747. There will also be time for questions at the end. I'd like to introduce our engine panel. I'm pleased to be joined by two of our engine team. We have David Archer and Gary Leung. Welcome to you both. We do encourage questions as it makes for an interesting discussion at the end. If you have anything you would like to ask, do drop us a line using the question pane on the control panel. Well, that's all from me for a while. Gary, I'll pass over to you to get started.
Thanks, Mel. So to begin, I'm going to look at the narrow body ordering activity over the last year. So overall, across all aircraft classes, orders have been lower than during the peak periods of 2011 through 2014. Narrow body orders have followed that similar profile. These peaked in 2013 with around 2,552 aircraft orders. Last year in 2018, the net orders were 1,390 aircraft. As expected, most of the orders came from the A320neo and the 737 MAX families. Large numbers of undisclosed orders, as you can see in the top left quadrant of the pie chart, have primarily come from the A320neo family. Many operators are likely awaiting the outcome of how Pratt & Whitney fix the GTF, whether that's going to be through a performance improvement package or whether they elect to go for a Mark II version similar to the V25A1 versus the V25A5 scenario. At the top of the screen, you can see the Pratt & Whitney 1500, and this powers the formerly the C series, now the A220. Operators have seemed to have been impressed with its performance. With some stating that fuel efficiency has peaked at 18–19%. But on the whole, Airbus had quite a difficult year in 2018. The A320 deliveries fell behind due to low volumes of engine deliveries. Pratt & Whitney had to divert some of their engines to its spares pool to alleviate the AOG pressure. And therefore, Airbus weren't able to fulfill all their orders due to those issues. And what we saw were a large number of gliders, which are essentially aircraft without engines, parked outside the final assembly lines. But on a more positive note, as I mentioned earlier, Airbus did confirm that they took over the C series midway through 2018. And with that, they rebranded the C series to the A220. And towards the end of 2018, we saw 60 orders placed by JetBlue and another 60 by startup airline Moxie. Delta also increased their total orders to 90 by adding an extra 15 aircraft at the end of the year as well. From a Boeing perspective, they had a more positive year. They registered more orders than Airbus for the first time since 2014, and this was largely driven by the 737 MAX. In total, Boeing recorded 698 net orders for the MAX, and you can see from the bottom of the pie chart that huge chunk for the LEAP 1B. Looking at the graph on the right, this is the current narrow-body engine backlog, excluding any spares. On the left of the graph, we've got the 737 MAX with the LEAP 1B, and to date, we've received, CFM have received 9,232 engine orders. Towards the middle of the graph, we've got the A320neo split into LEAP 1A, Pratt & Whitney, and undisclosed. In total, that amounts to 11,626 engines, or 5,813 aircraft. And as you can see on the right, there are 2,118 aircraft yet to have an engine selection. So moving on to the wide body market. Again, Boeing took the lead in 2018 in terms of net orders. Across the whole market, there were 366 aircraft orders in the wide body market. Most of these were for the 787 with the Gen X 1B. You can see dotted around the pie chart, we've got some of these older, more mature engines, and these are largely for aircraft such as the A330ceo, the 767, and in the 777. and these were largely again for freighter or military platforms. Over a third of the orders in the last year were for 2 Airbus aircraft, and these can be seen at the top with the Trent 7000, which powers the A330neo, and the Trent XWB, which powers the A350. What we haven't included on the chart is the orders from 2019 so far. Since the turn of the year, IAG, the parent company of the likes of British Airways, Aer Lingus, Iberia, they've ordered 42 777X aircraft, which are powered by GE9X aircraft engines. They've ordered 18 firm. They've had 18 firm orders and 24 options. And interestingly, this is the first time we've seen orders since 2017 with Singapore Airlines. But perhaps of greater importance is the A380 program with its cancellation, which David will touch on later. Airbus rather unlovingly cancelled that on Valentine's Day, and this emerged after news had been floating around that Emirates had struggled to reach a deal with Rolls-Royce on the engines. So in the end, Emirates elected to swap that A380 order for 30 A350s and 40 A330neos. And so we expect that that A380 program to really wrap up by 2021. Looking at the chart on the right, again, this is the wide-body engine backlog, which excludes the spare engines. And you can see there's a number of peaks, and these are largely for new aircraft technologies such as the A330neo, the A350, 777X, and the 787. The remaining dwindling backlogs that you'll see are largely, again, for mature engines, and these, again, will likely go to freight and military markets. What I'll cover next is looking at the CFM 56-5B, 7B, and the IAE V2500A5 historical events. And these will cover over the last 10 years, and in many cases, the trends follow quite similarly across each engine. What you'll notice is the light blue delivery line, and what we have seen is after the replacement aircraft have come into service, that those deliveries drop quite sharply coming up into 2019. What's also evident is the light green bars through the middle of the graph, and these are the aircraft that are re-entering service, particularly after 2014. Initially, these were due to falling oil prices, and the operators wanted to take advantage of that. But as we moved into 2016, 17, and 18, where the oil prices rose, we still noticed that those aircraft re-entering service increased, and we can attribute this to in-service issues that have been experienced by the A320neo and the 737 MAX. Because the LEAP and the GTF have had those early issues, there have been delays in deliveries, and in some cases there have been aircraft groundings, and so operators have had to fill that capacity void, and they've turned to the tried and tested A320ceo and NG. Looking specifically at the CFM 56-5B, we can see that deliveries peaked in 2016, and that was the same year that the LEAP-1A entered service. In subsequent years, we've seen that delivery profile decrease as Airbus have swapped from the A320ceo to the neo production line. There have also been an increasing number of parked and stored aircraft, and that's owing to the age of the fleet. The oldest that we have recorded in service, according to IBA IQ, is 25 years, or nearly 25 years. Even though we've got the oldest at 25 years, what it should be said is the average age of the fleet is still relatively young at around 9 years. And that's due to the large number of aircraft and engines that have entered service relatively recently. As this fleet ages, we're expecting to see a greater number of retirements and scrappages, but again, we shouldn't see this as a negative on the market, because that'll only be a small percentage. To date, only 2.5 or under 2.5% have either been retired or parted out, and the advantage here is that it will release used material into the market to support maintenance, repair, and overhaul. Moving on into the V2500, and this is the competitor to the CFM 56-5B. The V2500 has about 44% market share in the A320ceo, so it's essentially the minority in against the CFM 5B. Deliveries for this peaked in 2014, and it's had a smaller backlog, which has seen a more dramatic reduction in the number of deliveries in the recent years. The average age of this fleet is also slightly older, at around about 9.7 years. And again, that's down to not as many deliveries in recent years, so it didn't help drive down that average age. And it's got a same profile in terms of the parked, stored, retired, and parted out. And those that are parted out are providing good feedstock for the market. Moving finally into the CFM 56-7B, which powers the 737NG. This is the sole engine option for Boeing on this platform. And to date, there have been around about 14,006 deliveries, again excluding any spares. There are further 300 engines expected on backlog, and this gives an average age of just over 9 years. The CFM 56-7B is marginally less mature than the A320ceo. It entered service about 3 to 4 years later. And as such, the oldest aircraft in service is currently just over 22 years. The parked, stored, and retired and parted trends are similar to the other engines, but with the re-entry into service of quite a lot of these engines, these aircraft and engines, it's been offsetting those numbers. So looking at the engine value forecast for 2019, this chart shows IBA's view of the 2019 half-life current and the forecast values for some of the most common thrust variants in the narrow body market. What I want to do here is discuss some of the events that we are seeing in the market, and particularly the fact that these three engines are among the most common that we appraise and the most common transactions that we see, whether it's by leasing companies, investors, or teardown entities. The V2500A5, it's still maintaining quite a good market strength, despite the fact that the engine is still receiving quite a few fixes through the MRO network, and some of those fixes include the HPC Stage 7 blades, the HPT Stage 1 and Stage 2 discs, and the number 3 bearings, to name a few. Because there are some of those fixes are still ongoing on the V25, there have been delays in receiving the necessary material, which has increased the shop visit turnaround times. That has fed through, and it's given good appetite for spare engines, whether it's on lease or for teardown, to feed the shop. Looking at the non-select B2527A5 engine, that engine is still achieving strong lease rates with around 100 to 120,000 US dollars per month, inclusive of reserve rates. On the higher thrust variants, the V2533A5, which powers the A321neo, we're seeing lease rates in excess of 140,000 there. On its competitors, the CFM 56-5B, we're not seeing as strong lease rates, but we are still seeing good appetite for the engines from lessors and teardown specialists. They're still taking on board the engine for spares, lease, green time lease, or part out. And some of the things that we're actually seeing from our side of the work is we're increasingly witnessing and performing more appraisals on aircraft transactions where the lessor will then remove the engines to place them on a green time lease before part out. Then looking further into the CFM engines, I want to talk about the CFM 56-7B26. That's the base model. In a short to medium term lease, those rates we're seeing those rates around about 80 to 100,000 per month, and similar rates for the CFM 56-5B4, which powers the A320. Both of those are inclusive of reserve rates. On the lower thrust 5B6 variant, which powers the A319, we're seeing rates there of around about 65 to 80,000 US dollars per month. But what I want to note here is that not all of the engines that we see follow these value curves. Each have their own slight differences and intricacies, and not all are in a perfect condition when we appraise them. So as appraisers, what we need to do is take those into account, understand the conditions of each engine, and that's ultimately reflected in the values that we provide during appraisal, I should say. So giving an example of some of the data points that we've seen through the market. We've witnessed non-select V2527A5 engines with neutral QECs in and around a half-life maintenance condition, with roughly 12,000 cycles remaining on its LLP, achieve over 7 million in the market. But on the other end of the spectrum, for a part-out or run-out engine, we're seeing the same model in bare configuration with roughly about 2 million, trading at 2 million in the market. And then to highlight the strength of market, and I'm going to stress here that it's sort of a one-off case. It's not something we see very regularly, but again, just to highlight the strength of the market, is that we've witnessed non-select V2533A5 engines, which had missing records from the early to mid 2000s, trade for roughly the same as those with a full suite of back-to-birth traceability records. And again, I want to stress that that's not indicative of all the trades that are occurring. It's just to highlight the market strength, as what we would do as appraisers is typically see at least a discount of about 20 to 30% there. So what I'm going to cover next is the shop visit forecast for these narrow body engines, and this is IBA's view of the future profile for the next 10 years for the 5B, the 7B, and the V25A5. And this is a much discussed topic in the industry. As you can see here, CFM account for most of the shop visits that are expected, but that's largely due to the fact that the 7B is the sole engine option for the 737NG, and also that the 5B is a leading market share in the 320ceo. But on that, despite the fact that we do have more 5Bs, you'll see that the V25A5 actually has a higher count in terms of the engine shop visits, and that's down to the 5B being known to remain on wing for longer than the V25 at its respective thrust ratings. In the past, IBA has also spoken of the bow wave of shop visits that the industry should expect, and we believe we've entered that at this point. We're seeing increasing numbers of shop visits, and we're expecting that to continue through the middle of the next decade, as large numbers of these engines will reach their first run shop visits. But towards the middle of the next decade as well, we'll be seeing a compounding effect of the second, third, and fourth run shop visits. What's also evident from the graph here is the shift to the right in terms of the number of 7B shop visits, and as I mentioned earlier, that's down to that platform entering service slightly later than the A320ceo. The 7B also has a few more lower thrust rated engines in comparison to the A320ceo engines. And typically, but it's not always the case, these engines achieve longer times on wing due to less deterioration in the core and to its engine performance. In building this analysis, we've considered quite a few factors. We've incorporated a retirement forecast into the analysis, and we've included the OEM estimated intervals. On top of that, we've included the environmental impact of operating these engines. For example, in the Middle East, you're not going to see it operating as long as maybe in the likes of Canada or North America, the North American region. We've also included an allowance for green time, and this is particularly evident towards the right of the curve, where we'd expect the maintenance techniques to change in order to keep these engines on wing for longer as these engines approach maturity. And like I said, this is more prevalent towards the sunset of the engines, where we'd see large numbers of retirements, and that's because operators or lessors aren't willing or aren't likely to invest heavily in those assets, whether it's an airframe or an engine. But from that green time allowance perspective, that's more of a prediction rather than something that we can really do analytically. So with that, what we've seen here is greater numbers of shop visits in the coming years, and what follows that is the spare engine demand, which we'll see in the next graph here. So this is an estimation of the regional spare engine requirement, and this data is based off of the current engine fleet that I've extracted from IBA.IQ. And what we're showing here is the number, what IBA expect the number of spare engines to be in circulation to support the fleet through maintenance and overhaul. The trend here follows quite similarly to where these engines are concentrated, so the likes of Asia Pacific, Europe, and North America. And again, like with the shop visit forecast, we build in a few different assumptions and estimations, such as the OEM estimated intervals at each of the regions. And that regional aspect will have a bit of a knock-on effect on the number of engines required. So areas in Asia Pacific like China and India, or areas like Middle East in particular, will require more spares due to the increased downtime because of the shorter intervals. What I'm moving on here to is the demographics, or these key market indicators, and on the table on the left here, just as I've mentioned, Asia Pacific, Europe, and North America have high concentrations of these aircraft. Quite a lot of the operator base is located here. I'll touch on Europe first on the left graph. You can see if we total the 5B and the A5 engines, that far exceeds that of the 7B, whereas if we look at the North America fleet, the 7B engine, or the 737 there, far exceeds that of the A320. That's perhaps down to North American operators buying North American aircraft from Boeing, and likewise for Europe, that's European operators perhaps buying or more interested in taking on Airbus fleet. Looking at Asia Pacific, we're pretty level there really, and what you'll notice from there in the middle table is there's a few operators here who have split fleets. We can see that in through China Southern, who operate the 737 NG. They've got 380 engines there, but then they've also got 322 engines on an V25 powered A320s. And then looking to the right, these are just some of the recent orders that we've seen on IQ. And as you can see through 2017, 2018, 2019, those number of orders are decreasing, and quite a lot of these are for military aircraft. I want to touch briefly here on the LEAP and on the Pratt & Whitney. And I imagine for CFM and Pratt & Whitney, they're sick and tired of hearing everyone hammer how many issues there are there. So we're taking a step away from that, and we just want to show you some of the fleet demographics, some of the order backlogs, see things of what to expect coming into the future. And on the top left here, that table showing the current in-service fleet, largely active. Any that are parked and stored, particularly on the Pratt & Whitney side, are down for maintenance. As I touched on earlier at the start with the first slide, we've got a large number of undisclosed orders. And then through the middle, we're showing the current in-service fleet. So that's the top 20 operators of the A320ceo, and that breakdown between the engines, the LEAP and the GTF. And then on the right-hand side, showing the top 20 orders we have at the moment, and again broken into the engine OEMs, and I've given the total column there so you can see significant amounts are undisclosed. If I move on into the next graph, this is looking at the 737 MAX. We've had to update this recently, and as we're all aware of the tragic circumstances behind the Ethiopian flight. So after that, many of not all of the safety authorities across the world have grounded that fleet, and that's represented by the parked numbers, the parked percentage in the table. Below that's just a graphical representation of the number of operators per region and how many aircraft we're seeing in service in those regions. And again, similarly to the slide before, the two tables to the center and right, just showing the number of in-service operators and the order book that we're expecting to see. And finally, this slide covers our forecast over the next 10 years of each of those engines on the Neo and on the Max. And what people will likely, or what we have been asked already, is how is the Pratt & Whitney GTF issues and how are the 737 MAX groundings going to affect the values going forward? Now, at IBA, we don't tend to take knee-jerk reactions to those market events. We expect Pratt & Whitney to continue to invest in the GTF. They've told us and they've told the market that they're going to and continuing to rectify those issues. And similarly, we've seen Boeing already release a statement to say they're releasing a software patch on the 737 MAX. And so in the near term, we don't expect any issues, and that's going to follow into the future. We will, however, review our value curves if anything major happens in the coming years, and at that point, then there might be reason to then alter where our approach is. But for now, like I said, we don't subscribe to knee-jerk reactions to any of the market events. So now I'm going to hand you over to David to cover the remaining slides.
Right, thank you. So what we're looking at here is, I just wanted to touch briefly on the additional GTF engines. So starting off, I want to discuss the Pratt & Whitney 1200 and 1700. Obviously, these are engines that aren't in service yet, so we don't necessarily have so much information to share on them. There's a higher level of commonality between them, as you also have with the Pratt & Whitney 1500 and 1900 engines. On the Pratt & Whitney 1700, it's obviously quite fair to say that they have been struggling to find orders, largely due to the scope clause, which remains in place likely until late 2019 or 2020, when the pilots' unions will decide what happens next. An initial order with SkyWest, which was seen as a very good sign, has obviously been cancelled since. And as we stand today, there are no orders in place for the E170 E2. If we look back at the fleet of the current generation E170, E175s, a couple of top operators, just as an example, Republic, they've shifted some of their orders towards A220s, whilst also taking on an order of E175 LRs. But this order does have the opportunity to switch to the E2 as necessary. So we might see some changes in these order books going ahead still. SkyWest, they've taken some recent deliveries of E175 LRs, but they've also shifted to the Mitsubishi MRJ. And there's many other operators as well of the current E170 fleet that have yet to place new orders and may well be waiting for the scope clause to change to see what happens next. The PW 1200, different market, obviously on the MRJ, surprisingly strong with the orders. 100 aircraft with SkyWest, 50 with Trans-State Airlines. And obviously a few Japanese airlines, Japan Airlines and ANA with 32 and 15 respectively, along with a few lessors, which obviously shows some promise for the future of the market. Obviously the two top orders as well with SkyWest and Trans-State Airlines does show some potential for the North American market for this new entrant to the fleet. But both are obviously holding off on deliveries until the scope clause is completed. Now, if we go to what we're seeing on the slide here, which is the Pratt & Whitney 1500 and 1900, again, these are showing a very common architecture with a high level of commonality between them, whether it's in the architecture, the thrust, bypass ratio, fan diameter. These are two very like-for-like engines. Obviously, with the 1500, you have a different market dynamic. It's not so susceptible to the scope clause difficulties, which has, in fact, won it some orders as well. In fact, compared to the regional market, we've obviously seen a significant growth in orders since 2015, as you can see in the bottom right there. The PW 1500 entered service in 2016 on what was then the Bombardier C series. Good sales, but they somewhat slowed. But with Airbus's takeover, we've seen a fairly strong number of orders coming in. And currently, top orders come from Delta, Moxie, JetBlue, and of course Air Canada. Right now we have half-life values around 6.7 million, but overall we see a good value future for the engine, somewhat in line with what we saw for the V25 and the CFM56-5B in the past. As for the Pratt & Whitney 1900, this is unfortunately susceptible to the scope clause, perhaps not as much as on the E170 with the PW 1700, as this aircraft has typically found a bit more focus outside of the US market, which has been more focused on the E170s and the CRJ fleets. Top operators looking back on previous E190s, you're looking at Azul in Brazil. They've currently got an order book of 51 of the E190 E2s on order, so that shows a good level of confidence in the fleet going forwards. However, you have JetBlue, who's shifted now to the A220 based on profitability analysis of operating the fleets. So obviously there's some potential there for the A220 taking over some of these previous E190 operators' fleets. Potential change, as with the PW1700 for the scope clause when it changes, but perhaps less so as this has never been a North American favorite as compared to the E170. With regards to issues carrying over, obviously the PW1100 has had its fair share of issues. There are some in place, however, obviously without operators like Indigo operating the fleet in harsher environment and with fairly small populations in place at the moment, the impact has been very minimal, if any, really, to be seen. Pratt & Whitney are working hard to resolve carryover issues like the number 3 seal and combustor cooling issues. One thing we are still to see is the impact of LLP reductions, which we saw recently on the PW1100, which were quite severe. However, we don't expect that to be as dramatic going forward. None of these effects are expected to impact values going forward, or it's to be entry into service teething issues, and there's no sign really of poor market performance from these values. We move now into the current generation of the regional market, which is obviously focused very heavily on the CF34. The chart you're seeing in front of you is the historical events of the CF34-8C, historically on Bombardier's CRJ and Challenger fleets. It's a bit more of an aging platform when you're looking at the CF34s. However, deliveries have continued to this day. SkyWest, China Express, and Ostrom all receiving deliveries in the last year. We did see a small peak in deliveries in 2014, but overall the order book is continuing to shrink as would be expected. This is a maturing fleet. Increased parking activity has largely been counteracted by re-entry to service, but we would expect to see more retirements in coming years as older examples start to reach 20 years in service. Overall, it's the same message really across the entire CF34 fleet, but shop visit demand is quite strong. Will just help to push up values, along with obviously scope clause difficulties, meaning that operators are returning to older fleets. If we were to take an example of the value of this engine at half-life, we hold the value around 3 million, lease rates 35 to 45,000, holding fairly consistent to where we were a year ago. If we move to the next slide, we're looking at the CF34-8E, which is obviously on Embraer's E170. Counterintuitively to the rest of the fleet, this has actually done quite well recently. Obviously, with the scope clause, meaning some operators are shifting back to the original aircraft, but also Embraer is marketing the E170 as an alternative to the E2 in North America until the scope clause changes. Active and parked and stored events are rising, but current fleets remain very healthy, as you'll see in a few slides as well, and with a very strong active fleet in service. Recent orders are focused primarily on the E175LR, which should see deliveries for the engine out to 2022. That said, some of these orders do have a clause which allows them to switch up to the E2, so we may well see this order backlog drop when that comes into play. Overall market remaining strong. A good example, fresh from the shop, half-life LLPs 4 to 4.5 million, lease rates 40 to 50K. And finally, if we come to the CF34-10E, again, park and stored events are still are on the rise, but the majority will remain active, as you'll see in a couple of slides. Less likely to be helped by changes to the scope clause, as obviously the market is more focused outside of North America. The last real remaining order is with Nordic Aviation, which is set to feed into the European operator Helvetic Airlines. It's a fairly young fleet, though beginning to age, as unlike the 80, orders have not really picked up in recent years, and so we're seeing a drop-off. Oldest examples are around 15 to 16 years, but the majority are falling within 6 to 12 years, so it's a fairly healthy fleet. It's an expensive engine to maintain. The maintenance maintenance costs are somewhat on par with a narrow-body engine such as the 5B. And at the same time, part outs have remained minimal due to the higher cost of the engine. We do expect to see more examples of the aircraft to be parked in coming years, and perhaps some more availability and a slight softening in the values. However, the market has remained fairly strong to date. And again, an example of value fresh from the shop, half-life LLPs, 6 to 7 million depending on thrust, and 55 to 75k in rental. And this is just an overall look at the market. Some additional charts for your reference. The left is showing the historical order book across the CF34 family. Obviously, you can see 10E orders were fairly strong until recently, and the 8E has had a real pickup in the last few years. Overall, the market remains to be diminishing, and scope clause changes and orders shifting to the E2 could obviously diminish this further. In the center, it's a graph showing how the fleets are made up in age ranges. So you can see the older CF34 3As and 3Bs are really starting to mature now. The 8C has a bit more of a favor towards the back end, but has seen production through to today. The 8E and 10E have seen fairly similar lives, but in recent years, the 8E obviously has taken the lion's share, which should see perhaps a longer life on the 8E engines. And to the right, it's just the market standing to show active parked and stored, and what you really have to take away from that is just how positive the market is currently, and the very high level of active aircraft remaining in the fleet. If we were to look across all of them, the 8C average age is just over 10 years, the 8E is just below 7 years, and the 10E is just about 8 years. So it's really, it's a fairly young, healthy market still. Overall conclusion for the fleet of the CF34s, values have remained fairly consistent to last year. Demand remains quite strong for the engines, especially until the scope clause allows for orders and deliveries of these newer aircraft. Short visit demand is very high, perhaps comparable to the narrow-body engines. It could be argued that that is a carryover from CFM and V25 demand. However, even shops purely focused on CF34 have seen very high demand and are running pretty much at capacity. Obviously, and this is a good sign as well, just for continued investment in the assets and making sure that the engines see a strong future. We see a potential softening as the next generation enters the market and as we see more parts and stored events occur. But for now, against a very strong market, it's becoming more and more attractive to boutique lessors who've taken up a prime position in the market, and it's attracting new entrants who are moving away from perhaps the overcrowded narrow-body market. A big benefit for the CF34s has always been a strong and open aftermarket, which has allowed the engine to have a prolonged operating life, which we hope to see continuing forward. However, not all engines have this, which is kind of the next topic I wanted to touch on, which is the level of OEM control in the industry. You know, this is obviously a fairly sensitive subject. I'm not going to go into too much detail on any one OEM. However, the trend is clearly for OEMs working to increase their market presence. Historically, this has been a bit more of a wide-body discussion between GE and Rolls-Royce, but we're seeing a pretty marked change with the entrance of the LEAP and the GTF in recent years. In the narrow-body market and inevitably in the regional market too, with the GTF engines. Care programs are looking at over 60% uptake on the LEAP and over 90%, if not 95% plus on the GTF, partially due to uncertainty with the new architecture. So why is it that we would say, you know, an open market is so beneficial? Well, residual values always improve due to an open secondary market. It improves the liquidity of the asset, the ability to trade the asset on an open market. It gives owners and operators the option of how they want to maintain and run the engines. So they want to short build the engines to make the most of the remaining life. So they want to use used material, perhaps in more mature fleets, PMA parts. And obviously the access to maintenance reserves is always a touchy subject with lessors. In our experience, an open market is always a positive for the fleet longevity and seeing a strong future for the market. Obviously a big factor there is just MRO competition and keeping prices down. However, there are benefits and there are reasons why we're seeing the OEMs push for a stronger market control. Obviously, the OEMs tend to sell the engines at a loss, so they need to make their revenues back somewhere. but there's also benefits like reduced operator risk. Recent instance with the GTF and Trent 1000 difficulties has seen OEMs absorbing a lot of the costs. It's a great opportunity for any operator to offset the risk from themselves, which is obviously very beneficial. Now, we also have, with CFM pushing for this, there are worries of what could potentially happen, but with the CFM IATA pro-competitive agreement, obviously there are some benefits there. They're proving that they're open to used material, PMA, DER repairs, honouring warranties on engines without CFM parts in them, allowing competitive MROs to use the shop manual. Now, this does focus on the CFM56, but CFM have stated that they want to push this through to the LEAP as well, in which case we would expect Pratt & Whitney to follow suit, and that it's a very good sign for an OEM controlled market, but tailoring more to operators' needs and perhaps opening up towards a more mature stage in the engine's life. Obviously, the other thing as well is when we look at the drawbacks of a more closed OEM controlled market, it's focused largely on what we've seen in wide body markets, and the narrow body market is intrinsically a very different market. Whether or not we'd ever see the level of OEM control in that market is debatable. Next, just a brief update on the Trent 1000's GNX1B and of course the Trent XWB as well. Without going on too much about what's been said before, Trent 1000 has obviously suffered some pretty major setbacks in its entry to service, IPT sulfidation, HPT cooling issues, IPC rotor resonance, IPC rotor seal difficulties. But Rolls-Royce has worked pretty tirelessly to rectify these issues, which I think we've all observed. And in 2019, we're expecting AOG events to significantly reduce. There are still a number parked as we speak. The GNX1B had its teething issues as well with the icing issues, but overall, a more uneventful and reliable entry into service has really helped the engine take a very dominant position in the market. If you look at the current in-service fleet, it's 62% in favour of the GenX. I would say largely the damage has been done, whilst the fleet isn't necessarily a mature fleet, based off of what is currently in service and the order book as well. It looks like the pattern that has been set so far is going to continue ahead. Now, we're not treating these engines differently because of these issues. We still see strong market values ahead for both set to perform well in the near future. However, obviously, market dominance by one engine does open up the potential for a larger market and potentially better value retention as well. But this is still to be played out, something that we still need to observe. We're not seeing this as a good engine and a bad engine, but two separate markets, clearly one with a more dominant position. Trading activity is little to none, as would be expected. This is still a very young fleet. However, values we are currently holding at a very comparable level. If you were to take a Trent at 74k thrust or a GenX of equivalent, it's about half-life values around 17 or 16.7 depending on the engines. Lease rates 230 to 250,000. Moving on to the Trent XWB, a little bit less to say here. Obviously, this had a fantastic entry to service when compared to the Trent 1000. There were rumblings of potential issues after the IBA in-flight shutdown event last year. It even impacted Rolls-Royce share prices. Obviously, people were sensitive to the issue. However, so far, there's no indication of larger implications or recurring events, but this is still something to be seen. Market is performing well, a solid order book in place, as you can see. Our forecast value curve is akin to that of the GE90, so we expect values to remain strong for a long time. Current market dominance right now, if you look in the top right, is very heavily focused in the Asia Pacific region, with 7% of the market. You can see some of the orders in place with Etihad, Qatar, Singapore, United, and Japan. It's a very strong backlog in place. But we're seeing a lot of recent orders. In 2019, we're seeing 67 orders already from Starlux. Emirates will be shifting over from the A380, and also Lufthansa shifting over from the A380, along with 787 orders. Outlook is obviously set to shift with these orders in place, as you can see on the chart below, and with Latin America, North America, and European fleets set to take a growing share in the market. To date, deliveries are set to continue to the late 2020s, but we would expect further orders to push us into the 2030s. It looks like there's a good potential as well for the A350 freighter once that comes along too, which should further extend the engine's life and service. Values, again, little to no market activity to be observed, which is not to be unexpected for a wide-body engine. We're holding half-life values at roughly 21 million for the XWB at 84,000 pounds thrust, and 25 million for the XWB 97. And lease rates will be in excess of 250,000. Now, as mentioned, some of the orders from Emirates and Lufthansa have shifted from the A380, and this is a subject that a lot of people have shown some interest in. It's easy to forget that the A380 has now been in service for over a decade. It was an engine designed for perhaps a different market, which has shifted much more so towards the narrow-body in recent years. The chart to the bottom left is a great indicator of that, showing obviously fairly similar market presence, but the order book shifting very, very heavily towards the narrow-body market. Quad engine aircraft are just no longer the way forward. Prohibitive operating costs and narrow-body engines are just owning the market. Since the Emirates order and Airbus's announcements, we've received many questions. There's a few that I want to address now, just as they're quite straightforward. No, engines cannot be swapped between Trent 900 and GB7000 A380s. The costs are rather prohibitive. No engines are not applicable to any other aircraft family. These have unique architectures and infrastructure designed around the A380. No, engines do not share parts commonality to other engines. I think people here are referring back to what we saw on the CFM56-5C on the A340 with compatibility to the 5B for some components, but that is unfortunately not the case. Emirates cancellation obviously had another big factor, which was that it was going to push the market in favor of the Trent 900. And what we see now is actually a fairly well balanced fleet once all deliveries are brought into account. In terms of the future, though, we need to review the market dynamics. The key trend that we're looking out for here is what's happening at lease ends. Obviously, there's the chart to the left shows a big peak in lease ends around 2024. But obviously, in the build up to that, we need to see what operators want to do with these aircraft once they have the opportunity to return them. And what we've seen so far has not been overly positive. We have Singapore's scrapped aircraft. We have Lufthansa announcing it's selling back 6 of its 14 aircraft to Airbus. Signs that Malaysia Airlines may be following suit with this. And Air France next year returning half of its fleet of 10 at lease end next year. But there are positive ways to look at this. Obviously, with Singapore's scrapped aircraft, the engines were leased back to Rolls-Royce successfully. These are earlier examples that are perhaps overweight. And by all signs, there's good potential for the part-out revenue from these earlier examples. But obviously, this will not be the case if the number of aircraft continue to increase being scrapped. Air France returning 5 of their fleet, but they are investing 45 million euros per aircraft in refits of the remaining 5 owned A380s. And the Lufthansa sale is a very good sign for Airbus supporting a secondary market for this fleet. Hi-Fly being a great example, very strong support from Airbus during the transition. Wet leasing looks to be a small niche market, but very profitable. It's a fast way for any operator to significantly boost their short-term capacity. And the rumor is that the fleet is booked out for the entirety of the summer season. Hi-Fly are actually looking for a second airframe, and likewise, BA are looking into the opportunities provided by second-hand aircraft entering the market to counteract Heathrow congestion issues. Our view on the engine values has always been conservative. We look at engines, aircraft, and components as well. The order book has never exactly looked overly strong. The lease end returns appear to be an emerging trend which could impact the market. And with operators suggesting a 12-year operating life before retirement, that's a potential significant hit to the future of the engine platforms. There is potential in the aftermarket, but it is limited. Obviously, with every aircraft that is parked, there's 4 engines entering the market. Rolls-Royce leasing Singapore's engine is not going to be an option for many as well. We're moving to perhaps a more conservative standpoint on engines and parts. when looking ahead, but this is something that still needs to be hashed out in detail, but likely we will see pullbacks in residual values and increased depreciation rates. Now moving on to a slightly more positive note. It's just a look back at the 747 jumbo jet, which recently celebrated 50 years in service. It's an aircraft design which has survived from the late 60s in one form or another, going from pretty huge success in the 80s and 90s to perhaps a more tepid market on the 747-8. The aircraft was initially designed to compete with 707s and DC-8s, and now is competing with 777s, A330s, and even A380s. It's a market perhaps shifting more from passenger focus to freighter focus, but this may see a bit more longevity in the fleet. It's been a bit of an icon in aviation history, but especially so from an engine standpoint as well. We've had 5 engines under the wing, whether it's the JT9D, the RB211, CF6, Bremley 4000, or more recently in the GenX 2B. However, there's also been some more creative applications of engines in the aircraft test beds, which most engine manufacturers have used at some stage. Whether it's the GTF with the PW1200 being tested whilst attached to the fuselage, the Trent 1000, the GE9X, or back in the day, the GE90. Some other pretty outstanding achievements for the aircraft as well. Ferrying the space shuttle, carrying the president on Air Force One, with the new entrant coming into 2024. We should see this in the air for some time still. And whether it was a firefighter with a 747 supertanker, or more recently as a telescope for NASA, exploring the atmospheres around Pluto and finding oxygen in the Martian atmosphere as well. I doubt we're going to see again such an iconic and versatile and persistent aircraft again. It's been part of aviation culture, history, and luckily we've still got a few years left ahead, despite a sadly declining market.
Okay. Thank you, David, and thank you, Gary. Some really useful and interesting and hopefully valuable content there for everybody, and rounding up with a very fitting tribute to the 747, an epic aircraft. So that's the end of the formal part. We have a couple of questions that have come through. Whilst we just take a quick look at those, I'd like to mention that the data used in today's session is from our Engine Value Book, as well as our online data platform, IBA IQ. The latest edition of our Engine Value Book will be published at the end of this month. Details of both the Value Book and IQ can be found on the data page of the website. We are offering free trials and demos of the platform. If this is something that you'd like to take a look around, then please do register your interest via the site or drop us a line. Our email addresses are on that first page of the slide deck. Okay, we only have a couple of questions. Sure. Gary and David, can I pass that back to you?
Sure. I mean, the questions that we've seen are largely around the MAX and the GTF. On the MAX, obviously we don't want to go too much into speculation. We've provided a statement on social media here, which you can find on LinkedIn, which should cover our views of what we see going forwards. But really, our standpoint is that it's a short-term impact that we don't see affecting the market in the long term. And as for the GTF, the question is whether or not we're going to see a PIP or a Gen 2, which is something that Gary touched on earlier. It's not something that we're looking to speculate on. I would say a PIP is more likely based off of the OEM's feedback. Obviously, nobody's looking to have an orphan engine like we have with the V2500 versus the V2500A5. It's entirely up to speculation now, but I believe it will more likely be a PIP, which should hopefully have less of a negative impact on the current fleet and service, and will be something that's hopefully retrofittable as well.
Okay. Thank you. We're going to leave it there. My thanks to David and Gary, and thank you everyone for listening to today's session. If you have any other questions, do drop us a line or email us. As I mentioned before, our details are on the first slide. We will be sending a copy of the recording out to everyone that's registered to today's session, so that will be coming through in the next 24 hours. So that just leaves me to say, on behalf of IBA, David, Gary and myself, thank you for joining us today, and goodbye.